Welcome to Investing in Startups. I'm Joe Mager. Our guest this week is David Gardner, co-founder of the Motley Fool. David's one of the best stock pickers of his generation. While for many VCs, a single 100x investment would be a career-defining win, David's earned a 100x return on 6 companies, including NVIDIA, Tesla, Amazon, and Netflix. We talked about breaking the rules of investing, optionality, letting winners run, and much more. David's one of the investors I've learned the most from over the years, so I really hope you enjoy this one. David, it's great to see you. Thanks so much for coming on the show.
Honored to be invited, Joe. Very much looking forward to our conversation together.
We have both done individually hundreds of podcasts over the years, and I worked at your company for 15 years, and somehow we have never done a show together. So I'm excited that we're finally breaking the streak. It's time. I love your new book, Rule Breaker Investing, and I'm not just saying that because I mentioned on page 144. Although that was a nice touch. It was fun to see.
I
that
loved
pop up
what
in there.
you found, and that was such a perfect nugget right for that page right there. Joe, I'm not even sure I dropped you a note and said, "Hey, man, I'm doing this." I just kind of did it because I was like, "It's
a fun Easter egg."
It's such an important point. So I think it may have hit you by surprise, and if so, a pleasant one. I hope. I was honored to include you. You are there forever. If you and I get struck by lightning tomorrow, no one will ever pull back that important point that you tweeted out some years ago that totally aligns with how I think.
Well, I got this book first for my son because I'm excited for him to read it because he just started getting investing this past year. And I haven't told him that, like, there's a very small reference to me, right? But it's in there, and I'm looking forward to him reading it. And Pop, you're in the book. And I'm like,
yeah, exactly.
So you've written different books over the years. I think this was a totally natural book in time for you, given where you are stage-wise, career-wise. I was really happy to see it come out. Maybe just to set the stage and get talking, maybe just introduce what rule breaker investing is and what that means to you.
Sure. So I think that it's a way of investing, first of all, and it's something that I just started home brewing in my early 20s. It really started in earnest when we launched on AOL in 1994. And it's an approach to the markets that goes often against people's natural instincts. A quick example, Joe, would be psychologists have convinced us, I think, through behavioral economics and other studies, that for humans, the pain of loss is 3 times the joy of gain. And that's kind of lab tested at this point. So that's just sort of a human truism. And maybe it's 2 times or maybe it's 4.1, but you get the general point. And if you really think about the implications for your money, it's completely wrong for what I think of as great investing, what I'm hoping to call rule breaker investing, what wins on the markets, because the pain of loss is tiny. The most you can ever lose is 100%, which sounds like a lot until you remember you can make a lot more than 100% on the other side. And so an example of rule breaker investing is that the joy of gain is infinite times the pain of loss. And it's one thing to say, it's another thing to do. But I think re-educating ourselves or being willing to break the rules and take a different approach has been very valuable for me. And so for this book, I basically left it all out there in the field. Everything I think about the stock market is in the book. That's my final stock market book, Rule Breaker Investing. And that would be one example of a rule that we break. And there are a bunch of others, and we can talk about it. You already know a lot of them, Joe, because you and I have worked together, not directly together, but alongside each other and enjoyed each other for many years, even if it was sometimes half a world away. But so I feel as if you and by extension, some of your audience will know what rule breaker investing is. But I would say most of the world doesn't. Most of the world is much more short term. Most of the world is trading, not investing. And breaking the rules sounds like something we're taught not to do in school. But for me, it's been the real way to create value. And to conclude my shaggy dog answer, I would say a rule that many people hold as a capital R rule today, I think you and I completely disagree with this one, but it's a good example, is that it would just be luck to beat the stock market. You shouldn't pick individual stocks because you're competing against monkeys, blind monkeys throwing darts at dartboards, and you're just as likely to win or lose as they are. And I completely disagree with that. And I do think you can and should pick stocks directly individually. And I think you can beat the market and expect to do so And that would be very rule breaking as a mentality even today.
I think maybe one of the signature aspects of your philosophy, which, and I realize I've known you for such a long time that maybe my face is kind of pressed to the glass, and so it's hard for me to kind of see all the different facets of it. But when I think about it, outside of focus on growth, quality is just super, super long-termism. Like, I've met a lot of people who describe themselves as being long-term investors, me included, but you take it to a really different level. Can you talk about what time horizon means to you as an investor and the importance of investing with a super long-term horizon?
Thank you. Yes. So I think that you and I are invested and should be for our entire lives. So for me, it starts with multiple decades. And let's hope it's more than that. And if we're playing the game right and we're generous and other minded, we might well be investing for beyond our own lifetimes, which means you're playing maybe 100+ year game if you are investing. And in the book, I won't strain listeners' ears here on the podcast, but in the book, I break down the etymology of the word investing. And we talk about what it really means to me, what it really feels like and sounds like. But suffice to say that I think we're invested our whole lives long. And I don't ever want to interrupt my own compounding train. I want to get in on that train, first depot that I can, and I want to stay on that train all the way across the country. And it's about the journey, not the destination, but I want to be on the train. And a lot of people are looking to hop off the train just before bad weather. And they don't actually know whether it's going to be a bad market year or a bear market or not. No one really can know. And in my experience, no one's really very good at confidently determining that for themselves or for other people. But naturally, as humans who fear loss 3 times more than we enjoy gain, we don't want to be on the train for 2008, 9, 2001, 2022, which often isn't really thought of as bad as 2008, 9. But at least for me, my portfolio, I was cut in half in 2022. So when people say like 10-year bull market or these kinds of things, I'm like, not for me anyway. Multiple times over the course of the Motley Fool history, we've watched the market lose more than half its value. And certainly any great stock that I've had, and I'm happy to say I've had a lot of them, I've watched those stocks lose 2/3 or more of their value, generally multiple times. But when you're playing the long game and you're really just invested in great companies and you're not getting too hung up on near-term valuations or worries about overall markets, systemic stuff, you're just like, I want to be a part owner of this amazing company that's adding value to my life and that of the world. I think you're just redefining what long-term means, I guess. And for me, it's lifetime. And so the good news is that I can relax myself and not really worry too much or have to be a genius about what's happening in this present market environment or where anything's headed in the next couple of years, because I hope I'm around for several more decades. And that's how I'm going to be invested. And, it doesn't mean everything grows to the moon. It doesn't mean we never sell any stock at all. But I do think it is a fundamentally different mentality than I would say almost everybody else or much of the investing world, let alone the world at large.
Top of my head, at least as of a few years ago, you still own shares of Amazon that you bought in, I want to say 97? Just for scope, for folks listening. Because I think when you hear long-term, a mutual fund manager who says long-term, their actual turnover is probably like, maybe 3 years to them is long-term, maybe 5, 10, you get really far out there. But, we were having conversations about shares you bought in 97, 98. That's a totally different scale. Do you still own some of those?
Yeah. And NVIDIA, which has been an incredible stock pick for Motley Fool Stock Advisor, was picked on April 15th of 2005. And my cost basis for members is 16 cents on NVIDIA at this point, thanks to 120-to-1 stock splits that have occurred over time. And coincidentally, my cost basis for Amazon is also 16 cents. So that's just a lot of fun for me to reflect on. And Netflix split 10-for-1 earlier this month, and that took my cost basis down to 18.5 cents. So I just think these are all such great, vital companies. And Joe, this is not true of every stock. There are companies that are not particularly good. There are cyclicals. There are not everything obviously has this kind of growth dynamic. But I'm focused on the rule breakers. I'm focused on the companies that do this. And when you could just be buying and buying and buying some more and not having to sell or not really worrying too much about selling, it's such an easier life. At one point in the book, I say something like, my favorite trade-offs are when there's no trade-off. And I truly believe this approach to investing you actually spend less time and make more money. There's no trade-off to that. And I don't want to make it sound like it works every time, and I don't want to sound naive. I've lived through every one of these tough markets we've been through, and I've had a lot of bad stock picks too, and I'm always happy to talk about those. But really, if you're playing the long game, you start to realize the power law, which as a venture capitalist you are very familiar with, also takes place in any portfolio that's invested for the long term, public market companies. And so, I'm often asked, I just did a podcast earlier today, and they said, when do you sell? Dave, do you ever sell? When do you sell? And my answer is, and this is genuine, like the vast majority of the sells that I've made in my life are because it was doing so well, I had to sell some more of it off and redeploy because it was getting too big. It blew up in my portfolio in a good way. That is the majority. And I believe anybody who takes this approach to investing, that is the majority of selling that you too shall do. And it also is often true, and you know this about me, Joe, is I'm generally the last to hold bad stocks. Like I'm the guy with the bag at the end. I'm still there going, oh, well, it didn't work out. But the good news is it's a tiny, tiny part of your allocation when it goes from 100, as Peloton did at its height, down to 5, as Peloton kind of has. It just doesn't matter that much to your portfolio anymore. It's regrettable. I hate multi-baggers that I end up selling at dramatic losses. But even you and I have talked about it, even dramatic losses, not even 100%. And so I think this is not the only way to approach the markets. And most people shouldn't do this based on their own time horizon, their own mentality or whatever. But this is exactly what I've been doing, and for Motley Fool members for several decades now. And it has worked absolutely wonderfully. And that includes all the warts and being wrong a lot too. So I just want people to know, I couldn't have written this book at age 29 because I was positing that valuation is overrated. I was positing that Amazon could be a bigger idea than people are thinking. I was positing those things, but now, looking back 30 years, we can say, okay, what actually happened? Where were we right? Where were we wrong? But now I've been to the mountaintop, I've seen what it looks like, and I'm trying to share that out to as many people as possible because I hope this book reaches people who are not investment professionals. I hope it reaches people who are just making decisions to save money, which is heroic in this world where everybody's overspending, to save, forego the benefit you would have gotten from that money and to invest it, and to do it in a way that is consonant with what you believe in this world and with your whole life long. And I think most of the world will do much better if it starts adhering to this kind of intuitive approach.
Most VCs would be over the moon with something that's like a 30 to 50x, which for most funds would be a fund returner. When you go on a panel, they mention that when you come on, and it can be career defining. I'm trying to think of the 100x's that I know of that you've had. So 100 baggers. There's Amazon, Netflix, Booking on that list.
Yep.
Disney, Marvel into Disney I don't know how that is. That still 100x?
I regret to say, Joe, yes, but not presently. So
okay.
Marvel into Disney has indeed been a 100 bagger, but I don't count if it's not still. It's a 59 bagger.
59's, we'll call it close enough. There's Nvidia. There's Mercado Libre. Am I missing any?
Tesla.
Okay.
Intuitive Surgical. Those
Pretty
are the
solid.
7.
Pretty solid. I think most folks would be very happy with one. I want to go back to valuation, which you touched on before. And a signature part of your style has long been to not get fussed about conventionally high valuations. And I'd love for you to expand on that and why that's the case.
Yeah, it's something that from the earliest days, I felt like people were making investing into too much of a math problem. And I think there are no numbers for the things that matter most, which is one of the little sections in my book that I enjoyed writing most of all. And chapter 12 of my book, which is entitled Overvalued in Quotes, is probably the most subversive chapter in rule breaker investing. But I guess it started early, Joe, when I was raised myself in a family where both my grandfathers were entrepreneurs. So I just like business. I love business, actually. So this is my way of saying that I had sort of a business-centric entry into the investing world. I came from business. And I started realizing, people aren't doing math around the things that really matter for one VC startup to succeed where another doesn't. Because what matters most to me is who's running the business. And if you have a genius visionary who can scale things and who is fun to work with, that is incalculably valuable at an early stage for a disruptive start in a new industry with a new technology. If you have those factors in place, it is hard to put a value on that at all. So I know that that matters very deeply, and there is no line in the income statement, statement of cash flows, or the balance sheet that expresses the value of who's running the enterprise. And by the way, there are bad CEOs out there that should have a negative number in that Excel cell in the spreadsheet because they are subtracting value from the companies that they are running. That is one of several examples of something that matters more than the multiple off of cash flow or earnings, which are outputs. We're talking about inputs that people are not judging or scoring because there aren't numbers for them. And so what ends up happening, Joe, and all of Joe's wonderful listeners, in my experience anyway, is that all the best companies have the best people and the best brands and the best corporate cultures, another squishy thing that nobody's scoring. And they are the innovators, another squishy thing that nobody's scoring. And all of the best companies have those things. Therefore, by definition, all of the best companies look crazy overvalued. And this is only something I intuited 30 years ago when I picked Amazon or when I picked Netflix or when I picked Shopify, or the list goes on of companies, Tesla, that I love, and all of whom were called overvalued. And I started realizing not only is that incorrect, because these ended up being the 100 baggers that were actually the most undervalued stocks when you actually think about it. Like, that was the most juice you could squeeze from the stock market's fruit, is taking any one of those companies or all of those companies, and that they were broadly perceived to be the ones to avoid. In a lot of ways, I think that's why it works, specifically leaning into so-called overvaluation.
Yeah, early in my career, I spent a lot of time tinkering with valuation models and spreadsheets. I taught the class at the Motley Fool for the
Love it.
the new analysts coming through. But in hindsight, I have to say I never made big money off an insight from a spreadsheet. I think that's a good ramp to talk about multiple futures, which is something that we talked a lot about at the office. There's a maxim in the book about it, and it goes to a line that says, go with the business that's opening up yet more options for itself. Can you talk about multiple futures, what that means, and maybe give an example or two? There are probably many where you've seen that in action.
Yeah. So it was Andy Cross, our mutual friend and the Motley Fool's chief investment officer, who something like 25 years ago said, David, I've studied Warren Buffett a lot. And here's the thing about what makes Buffett great is he loves to find companies that have one future. It's Geico. It's going to be insurance. It's going to be insurance in 1995, 2005, 2015, 2025, Geico. Sees candies. It's going to be candies. And he's great at that. But he's like, Andy said, you're the opposite. You love to find companies with lots of futures. And I said, Andy, that is very insightful. You're right. I actually really do. I love finding companies that have optionality, the word that we use a lot around the Fool. And by the way, when I say the Motley Fool, there are many Motley approaches, as Joe knows and others who know the Motley Fool listening. There's no single way to invest. And a lot of people at my company disagree with me or don't take my approach. And we're very Motley at the Motley Fool. So I want to make it clear what I'm saying right now, multiple futures. This is more my style than anybody else's necessarily. But yeah, Joe, I do love to find companies that can turn into a butterfly and then turn into a different butterfly and then another butterfly in another era, and they just keep going. And Amazon is probably, to me, the most obvious present day example because we've watched the company. I still have my Earth's biggest bookseller mouse pad. And so that's what it was in 1995. And then it comes public in 1997. And it was like, well, they've added music and DVDs now. So it's books, music, and DVDs. But I was like, couldn't it be almost anything else? And I didn't understand anything like the cloud, AWS. I don't think Jeff Bezos knew what AWS was back in 1997. But that's just a great example of a company that wasn't just the everything store. I think I just saw a headline that they're now competing with Waymo in San Francisco with Amazon Zoox. So we're talking about a company that is constantly opening up more possibilities, and they don't always work. There are examples of, the Amazon phone, or these are those things over the years that innovators are going to fail with, and that shows they're really trying to innovate all the time. So an obvious example is Amazon. But how about just Netflix? Netflix, as you well remember, Joe, we were mailing DVDs, red envelope, to
I
a
was
central.
explaining this to Jack recently, and he was like, so you would get it in the mail. And I'm like, no, I hear you. But at the time, you have no idea how incredible this was. Anyway,
Yeah.
I bored the heck
No,
out of him. But
totally.
yes, I remember.
At the age of 59, I know I'm a little older than you. I know you know about this, but you may not have lived this. Like, there was a time before DVDs and VHS tapes where it was just you saw the movie in the theater and then you waited usually 5 to 7 years for it finally to come on TV. Maybe the Monday night movie of the week kind of a thing. There was no access at all to watching. Like, I went and saw The Sting, which I think came out in like 1975 or 6. I went back and saw it 5 times in the theater because I absolutely love, and I still do, the movie The Sting and Star Wars. And literally, you couldn't even see the thing again until it came back on TV at some point. So yeah, there's been an unbelievable evolution from there till now. And Netflix wasn't there back then, but they've been around multiple views of what it took to entertain ourselves. And it did really start with that idea of queuing up a DVD list and getting the next one mailed to you. And obviously the rest is history, but the decision to decide to actually start streaming well in advance of everybody else, briefly leading to Quickster, which led to my Netflix losing 2/3 of its value in 2 quarters, which never feels good and will probably happen again at some point because these things happen over time. But then, doing its own entertainment, like, wow, Netflix branded shows, that itself was yet another multiple future. So, and now we're hearing about, some more video games. There's now live sports. So most abundance mentality, growth mindset companies, and most are not actually like that. But of those that are, most of them are most of the great stocks of any era. And that's why, well, when I wrote Rule Breaker Investing, I wasn't writing looking back at the last 30 years, although obviously that's all my data and what I have to draw off of. I'm talking about the next 30 years because this is going to keep recurring. I think that this approach is going to win in every era because most people don't want to lose it all. They think the pain of loss is 3 times the joy of gain. And it's only the VCs and those who have a VC mentality, actual VCs like you, Joe, or me. I'm not a VC, but that's the mentality that I take to the public markets. We're going to always be in the minority of those willing to take on risk, believe it might work, be willing to lose, etc. So I think this is going to keep recurring and working, but it's about that multiple futures. So yeah, go with the company that has more futures, that will create more futures for itself than the one that doesn't. And obviously, Warren Buffett's made a pretty good living off finding companies that don't change in a changing world. But I love to find the ones that can keep changing ahead and drive the change in the world. Those are the rule breakers.
In venture, we tend to talk about sizing up ideas through the lenses of team, product, market. And most VCs have a bias towards one of those being what they lead with. When you're looking at a company for the first time, something fresh, how would you rank those?
Yeah, I refuse to do so. I want them all to be awesome. So to me, I totally understand the question, and you're in the industry, not me, but I'm the person who sometimes rejects the premises of questions because I actually think you want to have all 3 humming and you want to just level them up as much as possible. I'm also the person who, if you know the Myers-Briggs, a lot of people know Myers-Briggs, free personality tests on the internet. That's a great example. But, I'm the person who thinks you shouldn't just be an I or an E. Are you an introvert? Are you an extrovert? I actually think we have both inside us, and we should try to be an amazing introvert for our introverted times and an amazing extrovert for our extroverted times, and a thinker and a feeler. You should be trying to do both. So if you like Myers-Briggs and you know what the heck I'm talking about, if you don't, I'll be short. You should be trying to max out your letters across all 8 letters. You shouldn't be like, I'm such an E, I can never be an I, or I'm such a this or that. I think we have the human capacity to be all the above. And one of the things I love about conscious capitalism, just to jump tracks here for a sec, is that the whole point of conscious capitalism is you're not saying this stakeholder matters more than this other one. 20th century capitalism was often taught as the purpose of a corporation is to maximize shareholder value. But at least my experience has been the best companies say, well, who are our stakeholders? Well, shareholders are obviously one, but We wouldn't exist without a customer, so customers are stakeholders. And obviously, our employees breathe life into the enterprise every day. They're stakeholders. Let's treat them well. And maybe our local community is a stakeholder, or maybe the environment, if you're a planet Earth-oriented business, is a stakeholder, if you want to recognize that. And the best companies are creating wins across all 6 or 5 or 4. They're not like, hey, we're all here just for shareholders. We're going to maximize it out for them. And so questions that ask me to rank are totally legit. And I'm kind of cheesing the question. This is a little bit unfair of me, but I'm like, I want you to have a great product. I want you to be a great team. I want you to have a wide addressable market. If you don't have all 3, I got questions. And I want you to have the mentality that all 3 matter. I don't want you to think this is the one that we look for first. And I realize many great VCs, and I'm not one, do frame things up that way and do have a defined answer and are awesome at that. Just in the same way that even though I'm not Buffett, I respect single company, single future mentality. So I can accept it, but it's just not my approach. Is that a fair non-answer?
Yeah, it's totally fair. I think setting a high bar might be a way to frame all that. It's like, look, we want all those things. And I think rejecting the question is healthy in investing sometimes. We would get the question at Lake House, which is a company that I started within the Motley Fool family of companies, from consultants and call it like sophisticated investors who come in and kick the tires on us. And we'd get this question of, are you optimizing more for upside at the position level or loss rates? And I'm like, both. I didn't really like that answer. I'm like, well, look, I push our team pretty hard on when we're right. I want to be right big. And I also want to be right more often than our benchmark. And they'd be like, well, you can't really do that. And I'm like, why not? Like, can't we work hard enough and have a good enough process where that's possible? And it turns out that is possible. But I think it's a mindset thing. Like, you're not going to achieve something like that unless you actually try and make it happen. And if you take like, oh, product, market, team, like we're going to trade on one, it's like, well, you don't have to. No one's forcing you to trade on it. You could just set high standards across the board. So
I love that. High bar, high standards is a great way of phrasing it. There's a good book called Total Leadership by Stuart Friedman, who's a professor at Wharton. And he basically goes after the concept of work-life balance. Again, this is another framework people use, but he basically says it's the wrong framework. If you're not trying to go, oh, I'm way too far work now. I got to spend more time with family. Oh, no, I'm spending too much time with family. Got to get back to work. He's like, there's actually 4 dynamics in our lives as leaders and as people. There's like your own personal fulfillment. There, extend that out one concentric circle to your family and be awesome for your family. And then there's your company or organization that you serve. And then there's your community or the world at large, depending on how grandiose you want to be. There are 4 dynamics there. And you can't possibly try to balance those things. What you want to do is make a decision creatively that tries to win across all 4 of those dynamics. So before I ever heard about conscious capitalism, I read Stuart Friedman's book and I loved it. I'm like, I agree. I think work-life balance is the wrong metaphor. It's all about thinking through where you're playing and then trying to win in a way that connects across those things. And by the way, it's hard to do and it's not going to work 100% everywhere all the time, but it's the right way of framing things. So that's why I like the high bar approach and answer.
one of the more impressive aspects of your run as a stock picker is the team around you also had great performance. So it's you and I step back from picking stocks at the Fool around the same time. So even though I haven't seen the numbers in a while, it's probably roughly right on what I'm going to say here. But I have 2 more questions for you.
Great.
One is talk about the first principle of the rule breaker portfolio, which is to make your portfolio reflect your best vision of our future, which I love. What does that mean to you?
To me, it's really the foundational first thought, first principle around a portfolio. I truly believe that that is how we all should be invested. And if you're self-directed, especially, a lot of people don't want to be self-directed, and not everybody has to care about our subject or love this conversation. A lot of people just want to mail it in, index it, keep going about their lives and not have to think about growing their money. And yet, the more that we grow our money in consonance with our own values, with our own passions, with our own beliefs, with our own intuitions about the future or the world that we want to live in, the more we do that, the more our money expresses that, I think not only the better will you feel about it and the more will you learn, But even more important, I think the better you will do. I'm very persuaded by the math that says if you are invested right alongside the things that you believe, the vision that you have for our future, you're actually going to do better than if you're just following my stock picks or Joe's stock picks or that index fund. So that for me is the first principle of a rule breaker portfolio. It's very much about agency. And I think as sort of a rational optimist and somebody who believes that we really do make a mark on this world, we're not having our life controlled by external forces we can't touch. Yeah, waves are thrown our way at all times, but as soon as a wave is thrown our way, our question back is, how can I surf it the best? Whatever the world is throwing at me, how can we surf that wave the best? And so with that, a lot of that is about what you think and what you do. And often it's about the language that we use. Like you'll never hear me say the word correction, which is, I think, a completely wrong term for something that people these days define as the market declining 10% or more. I think that's totally wrong-headed and not the way to think about it. So the language that we use leads to the thoughts that we have, leads to the actions that we take, leads to the destiny that we end up with. And I think we have a huge role to play in our own lives and those of our family and friends and the world at large. So I think a sense of agency and can do is really important to me. And it's baked into that first principle. Make your portfolio reflect your best vision for our future. And, the word that I want to underline there is our, because, we all have things that we would love, but I want us to think beyond just our own vision. It's for everyone's future, for the world's future. Like, I think we're going to do best when we're thinking a little bit more grandiose. You said earlier, Joe, high standard, high bar. When we have high bar thinking about what we think the world needs, and then we put our money toward that, there's actually causation happening there in tiny little ways for every one of us. Where we put our money, where we put our time truly does actually broadly create the future that we're going to enjoy or not. So yeah, to me, that's a really important principle. It's the bedrock principle to build any portfolio.
I love board games. You love board games. You have the biggest board game, strategic game collection of anyone I know of. Do you have a recommendation for, we've got 4 people at home. It's B Arena. We got Jack, he's 11. Maya's a very clever 7. Any recommendations on great games to play with the kids to get their wheels turning, but still accessible?
Absolutely. So for me, let's go with a cooperative game, first of all, because people don't often realize these exist. Younger people these days who know about games, and games are much more prolific and popular today than when I was Jack's age, for example. So fair number of us listening may realize there are now cooperative games, but many older hands don't realize that there are a ton of cooperative games. And a lot of people, in my experience, Joe, don't like games because they had Uncle Howie, and Uncle Howie used to beat them silly at Monopoly. And so they say things like, I don't really like games. I don't want to play games. Had they been playing a cooperative game with Uncle Howie, where we're working together to figure something out, we're playing against the game, they might feel very differently about games. So whenever I want to answer this question, I want to start with a game called So Clover, which is a fantastic word game that is a cooperative game that takes about 5 minutes to learn, half an hour to play, can be played by 2, 3, 4, 5, or 6 people. And it's right there on Amazon. And it's probably like one of the great game releases of the last 25 years. Very accessible. Let's just go on the other end really briefly. I mean, I think one of the best high-level strategy board games the last 15 years is Terraforming Mars, which is exactly what it sounds like. It's basically an economic simulation, and it imagines a future, which I do think will happen one day, where humanity terraforms Mars. Each of us is a different corporation with our own sort of different asymmetric starting position, and we are going to be paying to play cards to help terraform Mars together, but it's a competitive game. We are cooperating to raise the temperature to make it warmer on Mars and add water to Mars, which is going to be necessary to terraform it. But we're each going to be trying to add the most value from our own individual corporation and earn the most victory points. It is a fantastic game with multiple expansions, and I love Terraforming Mars. There are 673 other games in the room that I'm speaking to you from, and I'm not going to talk about others, but I hope I gave a nice range of like simple, cooperative word, right through to heavy duty. Terraforming Mars, an hour to learn, 3 hours to play. And so this is people who really love strategy board games. And I know some of them are listening to us right now and have already played Terraforming Mars and would probably beat me, because the last thing I want to say about this, Joe, is as many games as I know and love, and I'm the guy who teaches the rules, I'm actually not very good at games. I usually lose. I regularly teach people a game, and then they beat me at the game I just taught them. So don't confuse me for like an alpha gamer. I am an alpha game lover. I'm an alpha game teacher. I kind of suck at a lot of games.
David, this was super fun. I just bought So Clover on Amazon, by the way. So
Beautiful. You're going to love it. I really think you are.
look, thank you again for coming on the show. It's been way too long since you and I caught up. Hopefully we do this more often than it's been, but this is a lot of fun. Thanks again.
Thank you, Joe. I've always enjoyed my time with you. This hour, yet the most recent example. Congratulations on your success and all the good things you're doing on this world. And I hope that you're going to help bring some awesome companies one day to my portfolio. I'll have a much higher cost basis than you. But, in the end, I just love being invested in things and people that are going to make the world better. And I do believe that happens more than most people realize.
Thanks for listening to the show. We really appreciate the support and would love it if you'd subscribe to the podcast on iTunes, Spotify, your preferred podcast platform. One more thing. Investing in startups does not have sponsors, but I want to give a shout out to one of our portfolio companies, Micro One. Micro One helps businesses ranging from startups to enterprises to source world-class software engineers. Micro One uses their own AI tools to identify top 1% engineers and get them working for customers in as little as 48 hours. And if Micro One could help one of the largest AI companies in Silicon Valley hire 250 engineers in 30 days, they can probably help you too. If you'd like to learn more, visit microone.ai. And thanks for listening.
Joe Mager is the founder and managing partner of Seaplane Ventures. The content here is for informational purposes only and should not be construed as investment, legal, or tax advice. The opinions expressed by guests are their own and do not reflect the views of Seaplane Ventures. Our host, guests, and clients may hold investments discussed in this podcast. Please invest responsibly.